gold and silver are already on their way up. I mean, silver had this dump recently that, it was 4-week dump, but really it was one bad day. And if you go back over the last couple of years and look at silver's rise, well, go back, for instance, after silver made a high in 2020, got up to just short of 30 and fumbled around and then pull back for the next couple of years in like an overlapping pullback. And so did the gold and silver miners. They paused and pulled it, but whereas gold really went sideways during that time. So it outperformed them by not going down really, whereas they corrected down. That's shifting, favoring them now, silver and the gold and silver miners. But I see, when people get panicked by any quick pullback in silver, they need to stand back and look at what's going on. Where was silver a year ago? Where was it, for example, in March of 2024 when we put out a report to all our subscribers saying, okay, the dull markets we've seen since mid-2020 on gold, silver, and the miners. When the stock market broke from January through April, the bond market, gold was going up. It surged from early year to April while the stock market was going down. So money was moving into gold, but it wasn't moving into T-bonds. Now, right now, we've got a little rally going, a couple points in T-bonds for the last couple of days. But when you look at a long-term, even just a price chart of 30-year T-bond futures, or look at a yield chart, long-term rates, don't look at the short-term, it's clustered. You're really just stuck in ink sideways, but at very low levels on price, very high yield levels, in which case it almost doesn't matter whether rates go higher. It's just hanging around here is like a noose on many corporations, which have, as I understand, a lot of commercial real estate has debts coming due this year and next. So, they're not getting any relief, just if rates stay where they are. Now, the question is right now, is this T-bond rally we're getting over the last 2 days finally going to join gold as an alternative? I have my doubts. I'm not going to say it can't, but it hasn't so far. And frankly, we've got numbers below the market, which it has not yet triggered. I'm talking T-bonds now, T-bond prices, that if they get to you're going to have a mini panic in the bond market as well, to the downside in price, upside spike in yields. That hasn't happened yet. And the question is whether the government can keep it from happening, because we know they have a major debt problem. And it's, I don't, like Jamie Dimon has said, I don't think this time they're going to avoid it. So anyway, we'll see. But as far as an asset to buy to protect yourself against a losing stock market, so far it has not done what it normally does.
Yeah, great. And what do you see happening with, I guess, the deficit? Because as you said, Jamie Dimon saying it's an issue.
No comment on that. It's no comment on that. Obviously, if the economy weakens, then tax revenue is going to slop down as well. And we think a lot of changes could occur that are not just market or economic data points. If we go into the upset that I described, because certain factors engage now, let's say a downside stock market, therefore the data points head south, people's pain, personal pain gets even worse than it is now. Again, a lot of families are up to their head in debt and credit limits.
The U.S. deficit is ballooning at unprecedented speed, with national debt surpassing $35 trillion in 2025. Rising yields magnify the government's financing burden, while slowing growth threatens tax revenues. Analysts like Jamie Dimon have openly warned that fiscal stability may not hold this time. If the economy contracts, households already stretched by credit card debt and high living costs may struggle to meet tax obligations. This raises difficult questions about government revenue models. Could the U.S. eventually abandon income tax in favor of a national sales tax? It's an unthinkable scenario, but one that no longer feels impossible.
That certain institutions and notions that have prevailed for 100 years might go out the window. Wouldn't shock me there's no Federal Reserve in several years. Simply because, hey, it hasn't worked, guys. It's been boom-bust cycle monetarily, and therefore boom-bust cycle in the stock market. And more people are becoming aware that, this entity is not some savior. It's part of the problem. And if you get into an economic crisis, real in the street type crisis, where people are hurting, that's when things like that get doubted. Okay. Another one could be if we head into an economic downturn, the question is, what's the viability of the public to pay their taxes next April? I mean, people are hurting. It's hard to write that check, if you don't have the income, and therefore you're either going to be late, you don't file, or you're going to ask for an extension, or, in other words, suddenly government revenue from taxes could go whoop down. And it wouldn't shock me if they get severe enough, they abandon the income tax totally. Why? Because it's not viable as a source of income. And they turn to something else, like a national sales tax, for example. But all kinds of these variables are out there. I'm not predicting which will occur, but I bet some of them occur. And it's a 52 card pickup time coming. Watch that stock market. I think gold already knows what's going to happen. Namely, you're going to have a crisis. And it's going to be basically the key alternative, it and its fellow travelers, silver and the miners.
The Federal Reserve's credibility is increasingly questioned. Critics argue the Fed's policies have fueled endless boom and bust cycles, with monetary interventions distorting markets instead of stabilizing them. Should the U.S. face a severe recession, public frustration could escalate into calls for radical change, even dismantling the Fed itself. While extreme, such doubts reflect a broader erosion of trust in long-standing institutions. If inflation remains sticky while unemployment rises, the Fed's dual mandate could collapse under pressure. The result: a profound debate over whether the central bank is still a safeguard or a driver of financial instability.
It's had a big shot up lately, and no doubt they'll come down too, because again, it's not just, we've got a bubble, and if our economy turns down, you can say, whoa, this economy is doing well, but we're part of a world economy after all. And if you take a major country like the US and suddenly kick it in the gut, you can have wave effects elsewhere in terms of, how much they produce and sell to us, or, et cetera, et cetera. So it's not going to be limited to us. So it's hard to say fundamentally how some of these other markets that look technically better than ours, less vulnerable, particularly China. In fact, China is in a positive momentum trend by our assessment. It could change that. But again, if it turns down, it's not going to turn down like the US. So, if somebody came to me and said, I've got to have position in the world stock market, what do I do? I would say, well, go market neutral. Be short the US and be long emerging markets, which, EEM, the ETF, very popular ETF, it contains, I think, about 30% China stocks. Also Taiwan, South Korea, and a lot of other emerging markets around the world, and to a lesser extent, India, for example. But I think, owning that and being short the S&P, I bet you make money on the spread. Meaning, even if the emerging markets go down, they're not going down like the S&P, in which case you make money on the difference. So that would be a sort of a protective way to put your helmet on for the next year or so. Anyway, that's my thought on that issue.
The U.S. economy does not exist in isolation. A downturn in America would send shockwaves across global trade and financial flows. Yet not all regions face equal vulnerability. China, for example, has recently displayed signs of momentum despite its property sector troubles, while emerging markets in Asia and Latin America offer diversification opportunities. Analysts suggest a market-neutral approach, shorting U.S. equities while going long on emerging market ETFs like EEM, which heavily weight China, South Korea, and Taiwan. Even if these markets decline, they may outperform the U.S., providing relative gains for strategic investors.
Gold and silver are already on their way up. I mean, silver had this dump recently that, it was 4-week dump, but really it was one bad day. And if you go back over the last couple of years and look at silver's rise, go back, for instance, after silver made a high in 2020, got up to just short of 30 and fumbled around, and then pulled back for the next couple of years, and like an overlapping pullback. And so did the gold and silver miners. They paused and pulled it, but whereas gold literally went sideways during that time. So it outperformed them by not going down really, whereas they corrected down. That's shifting, favoring them now, silver and the gold and silver miners. But I see, when people get panicked by any quick pullback in silver, they need to stand back and look at what's going on. Where was silver a year ago? Where was it, for example, in March of 2024 when we put out a report to all our subscribers saying, okay, the dull markets we've seen since mid-2020 on gold, silver, and the miners, which have just put everybody to sleep or scared everybody because of their non-trending upward, but they didn't break the long-term trend that we measured. They went sideways, really. That was going to regain its upside potential at that point in March of 2024. Well, silver was $25, $26 then. Where are we now? 37, 38. So, it's not like it hasn't advanced more or less continually, but it's had a lot of protracted stalls and pullbacks.
Silver and gold miners have reawakened after years of stagnation. Silver's climb from the mid-20 and early 24 to near 38 today illustrates a powerful trend despite temporary pullbacks. Mining companies, long ignored, are now delivering robust profits per ounce, drawing fresh capital into this small sector. Their outperformance relative to gold suggests growing institutional recognition. When money flees equities, even a fraction flowing into miners can ignite sharp rallies due to their tiny market size. This wet bar of soap effect, where prices leap suddenly, is increasingly visible as investors seek safety beyond traditional assets.
In fact, we just went through one. Like you go back to May of last year when silver hit 32.70 after our signal at 25 to 26 bucks in March. By May, it was up to 32.70. This is May of 2024 now. And then it started to go sideways for a year with higher highs and lower lows, but basically a random sideways movement until June of this year. And that's when we put out a renewed signal again saying, okay, pushing up in the high 34s, we're gonna accelerate now. But yeah, we just had a pullback, we're trading at 37 now. Okay. I think we're in an accelerated phase for silver and the miners and gold in that order. Meaning the upside we've seen in this arm wrestling process is now going to go more vertical. And I think one of the factors that will spark that, will stimulate that, will create capital flow is money moving from the stock market, particularly when it moves into the teeny tiny little sector, the gold and silver miners, which is after all part of the stock market. And we've seen lately an unusual strength in the gold and silver miners as a category relative to gold even. And I think that is partly due to money getting more and more nervous about the stock market and saying, hey, we need another place to be. And good grief, these guys are actually making a lot of money per ounce, and we've ignored it. And now we're going to get into that tiny little category. And that's why you have this wet bar of soap type phenomenon where, we're going up pretty sharply and more so, I think. So anyway, that's where I would be for the next 6 months, especially, but probably over the next year and a half as well. But right now, I think there's going to be some drama between now and the end of the year, more than we've even seen so far. And I think gold's totally comatose sideways for 4 months now. April, May, June, and July close on monthly close. You could draw a line right through them. Gold never tops that way, by the way. Never. It spikes when it makes a high. This is total lateral sleeping sideways, while gold and silver went up during that time. When gold reasserts itself back over 3,400, especially 3,500, I think you're going to see a dramatic flow of money into that category again.
History shows precious metals often thrive during equity bear markets. From 2000 to 2002 and 2007, 2009, gold and silver gained while stocks declined. While panic events can briefly drag metals down, the broader trend favors them as alternative stores of value. With gold consolidating near record highs and silver accelerating, the setup suggests a powerful move is near. Once gold decisively clears $30,400 and especially $3,500, expect a surge of global capital into metals and miners. As equities face mounting risks, gold and silver stand positioned not just as hedges, but as leading assets in the unfolding financial reset.
The key issue for the miners is, and I know a lot of people are fixated on the notion that, if the stock market goes down hard, so will, gold, silver, and the miners. Well, first off, it's not true. You go back and look at the bear markets, just over the last 25 years, 2000, 2002, gold, silver, and the miners went up. 2007 to 2009, okay, up. They were an alternative. Yeah, sometimes you'll get an emotional week or two in the stock market where you get effectively a crash type event, though that's kind of rare in bear markets in the stock market. In fact, the 2000 to 2002, there was never a crash. It was just a bloody downside that was just constant, without a crash event. And in 2007 to 2009, there was 1 month in there in October 2008, a full year already off the high, well off the price high. You had a crash-like event. And at that time, gold, silver, and the miners all did have a sympathetic pullback. But in the context of the broader bear market, they were going up. For them, that was a corrective drop. And I think the recent example is pretty good. Look what gold did January through April. Well, stocks were puking, went up. Anyway, that's my view of the world here, and I think we're about to get back to a more dramatic behavior in the markets, both upside in the monetary metals and downside in the stock market, once we convince the ever bulls that this time it's not going to do what you think. That it's in fact more like the 2000 top to 2007 top, arduous, with teasing new high.